A dividend is a distribution of a company's earnings to its shareholders. From a financial perspective, dividend is one primary way the shareholders realize returns from their capital investment into the company. The other way is capital gains through the appreciation of the share price. Welcome to Lesson 8. In this lesson, we move on to one important aspect of the financial management of the company. What to do with the earnings of the company? Reinvest into the company to grow the business? Distribute the earnings to the shareholders? What are the key factors that will influence the decisions to pay out dividend? By the end of this lesson, you should be able to recognize that dividend is a strategic choice, not a mechanical rule. Recognize the trade-offs between returning cash to shareholders versus retaining cash to fund future growth. Apply disciplined analysis using a business intelligence decision metric to make decisions on dividend. You will be equipped with a disciplined framework for understanding and managing dividend decisions. In theory, a company could pay out all its profits or a percentage of its profits as dividends. That is, assuming the company has stable cash flows, a sustainable business model, and disciplined management. Paying dividends is a signal of the financial strength of the company. In practice, not many companies have such good fortune. Rather, many companies are struggling to stay profitable, working very hard to grow the business, and having very tight cash flows. Therefore, dividend decisions sit at the intersection of liquidity management, profitability, and investor expectation. Unlike other operating decisions, dividend is not an operational investment, but a capital allocation decision. Once cash is paid out as dividends, it cannot be used for marketing, R&D, procurement, capacity expansion, or risk buffer. Opportunity cost is a core consideration in decisions to pay dividends. Three strategic perspectives commonly emerge. Growth-oriented strategy, low or no dividend. Companies pursuing aggressive growth typically retain earnings to fund expansion. In the business simulation game, it is often observed that in highly competitive markets, investment in marketing, R&D, capacity expansion yields high returns. Paying dividends too early may constrain growth and weaken long-term competitiveness. Stability-oriented strategy, consistent dividends. Major companies with stable demands and predictable cash flows often adopt a steady dividend policy. The objective is not to maximize payout in any single round, but to provide reliability. In the business simulation game, this strategy reduces earnings volatility and signals operational discipline, even if it limits aggressive expansion. Value extraction strategy, high dividends. When growth opportunities are limited or marginal returns on investment are low, companies may return excess cash to shareholders. In the business simulation game, this often occurs when markets saturate or when additional investment fails to generate proportional demand increases. These strategies demonstrate that dividends reflect strategic priorities, not solely accounting outcomes. Opportunity cost is an important consideration in operations management. Every dollar paid as dividend is a dollar not invested elsewhere. The effectiveness of a dividend payout cannot be judged in isolation. It must be evaluated against the returns that could have been earned if the cash were reinvested. For example, If additional marketing spending could generate high-margin demand growth, paying dividend may destroy long-term value. Or if R&D spending had diminished returns, retaining cash may be inefficient, making dividends a better choice. Therefore, dividend decisions force managers to compare rates of return on reinvestment versus shareholder return expectations. We will skip applying the plan, do, check, adjust cycle in making decisions on dividend payout for simplicity. You will generate a business intelligence decision matrix like this one as a tool to help you make sound and logical decisions. The decision column is dividend. The outcome 1 column is earnings after interest and tax. The outcome 2 column, cash balance. The KPI column is going to be left blank for simplicity. In the real world, the most critical KPI for making dividend decisions is the return on retained earnings. Why? Because if retained earnings do not improve performance, it should be time to pay dividend. During the lessons, you are at the middle of a business simulation game that had gone through 4 rounds, and all the data and information are at your disposal. You just need to find them. You can find the decision on dividend in the business decision history page. The earnings after interest and tax in the performance financial statement page. The cash balance in the performance financial statement page. You must fill up all the cells, analyze the trend of the outcomes, and ask these questions. What is the trend of earnings after interest and tax in the past rounds? Erratic or steadily increasing or decreasing? What is the trend of cash balance in the past rounds? Erratic or steadily increasing or decreasing? Make disciplined judgment whether it is time to pay dividend. Decide on the size and justify it with data. What alternative uses of cash were foregone when dividend is paid? Did dividend decisions align with the company's competitive strategy? How did dividend policy affect financial flexibility in later rounds? Would shareholders have been better off with reinvestment or payout? How consistent was the dividend policy over time and why? Dividend is a capital allocation decision, not an operating expense. Effective dividend policies reflect strategy, cash flow stability, and opportunity cost. Paying dividend too early can constrain growth. Paying too late can waste capital. Consistency and justification matter more than payout size. The true measure of dividend effectiveness is long-term shareholder value, not short-term cash distribution.